Hi, class. Welcome back. Uh, End of this class, I will talk about the assignment, which is due next week. It's a first group assignment, so we will talk about it end of the class. So let's start with this chapter of this week. Here. Okay. This chapter is very interesting chapter, and it talks about the fiscal policies, which is chapter 7. It's the tools that usually the government utilize for improving the business, improving the life standards, and this is one of the main tool that the government will use. So we will talk about it in this chapter. So. In this chapter, we're going to learn this. We're going to able be to describe why the federal government's budget depends on the three factors: the rate of taxation, the size of the GDP, and its own spending level. We're also going to explain the pro and the cons of the budget policy aimed at the achieving full employment equilibrium, and we will explain the pros and cons of a budget policy aimed at achieving a balanced budget in each fiscal years. We're also going to talk about the pros and cons of a budget policy aimed at achieving both full employment and a balanced budget over the life of the business, and also discuss the cause, the size, the problem of a national debt. When is the debt is bad? When is the debt is okay? Now, what's a fiscal policy? Fiscal policy, which is about a government approach towards its own spending and taxation. How much the government is going to spend and how much going to be taxing the people. Um, the Minister of Finance bring down annual budget in Parliament each spring. It contains estimates of the government revenue and expenditure, and usually is a major announcement when they talk about their budget. And usually, the financial manager, I mean, the financial minister, the Minister of Finance, sorry, the Minister of Finance, get a new shoes. He wears the new shoes in the Parliament and announces fiscal policy. Now, let's talk about federal government budget fiscal year ending in March 2016 as example. If you notice here, we have just like any accounting, balance sheet, revenue minus expenses, and here where you have a as a revenue for the government is the personal income tax, the corporate and other income taxes, the EI premiums that they got, the GST, the taxes from goods and service taxes, excise, and energy tax. And there is non-tax revenue if they're investing in, in some corporations, or they have corporate ministry, operations, or they are investing abroad. This is non-tax revenue comes in, or they have oil in some countries. They can consider it non-tax revenues. Now, the expenses that they have is kind of the transfer to person, paying back to persons, and spending the grant to the other level of government. So if you have a federal government, how much giving each province amount of money, and the public debt charges. So what's the charges is for the paying back the debt and interest rate, and the direct program spending, how much they're spending into teaching, infrastructure, health, all these things is add up together. And the total expenses minus the total revenue. Here in this case, we have a deficit of $5.4 billion that year. Now, the fiscal policy, there is a net tax revenue, which is the total tax revenue received by the government less the transfer payment. So NTR is a tax revenue, whatever is generating, and less the payment transfer. See it as a person. NTR or net tax revenue is a salary that you get, and it's I mean, the tax revenue is like a salary that you get, and the expenses like a rent and food and all these things that the transfer payments is similar to that. So the net tax revenue is usually, in your case, what you make less than what you spend. Here is what the government generate from tax revenue less than transfer of the payment. Now we have what we call budget balance, which is the difference between the next tax revenue and the government spending. Now, sometimes we have a budget surplus and sometimes we have a budget deficit. What's a budget surplus? It's when the net tax revenue is in excess of the government spending. So when they are generating more income and they spending less on a goods and service. In the deficit is the reverse thing. So if the government spending on goods and services in excess more than what they are collecting as a net tax revenue. And if you notice here, by year, things is changing. So this is where it is really in a balance. It's a zeros, and in 2015 they had surplus, which is $2 billion, and it has to be balanced accordingly. Now, the Canada net national debt, if you notice, is what the government is owning. So it is increasing since 1980, but was decreasing until 2010 and increasing again. But that doesn't mean something negative or positive. They are investing in a certain thing which will generate for the future income. Now, here, what you see, the net tax revenue is, let's say, is a standard thing. So, if the government spending is less, then at Y3, there is a surplus, and is a real GDP at Y2. The GDP, it's a real GDP of Y2. The net tax revenue is a balance with the spending. So here where you are balancing, but here you got a surplus because you are collecting more money and you're spending less. And so it's the same. The budget line, if the budget's higher than what the government spending, is also you're going to have surplus because end of the year there is a budget that is not being spent, so we're going to have a surplus also. But overall, the at Y2 is the balance where the net tax revenue and government spending is, at this case, is really in a balance. So if, just in case, the net tax revenue is less, then you're running a deficit. So the government trying to be in the real balance, real GDP. It's when the government income and government spending, it's similar. Some years it's more, some years it's less. It's just they playing this. They trying to balance things, and also they're trying to invest in the future. Just like you, when you go and buy a car and you are spending more because you believe in 2 years this car will pay off. Its expense because you're going to utilize it at your work or something like that. Now, in the fiscal policy, very good other example. Today, you're spending on your education because next 4 years down the road, you're going to generate income from degree and education that you get. So today, you are spending more than you are generating, and down the road, you are generating more than you're spending. The fiscal policy. the government budget is affected by the level of the GDP, and we saw it whether it's it's a balance, real GDP, or and also is affected by a change in the tax rate. What's the percentage of taxes that they're charging in the rates, and a change in the amount of government spending, how much the government spending. Now, an increase in the government spending shift the the G line up because they're spending more, and then when they're spending more, shift will be lowering the real budget. The budget there is would be a budget deficit because when you're spending more, there is uh, you are spending more than what you are generating, so your budget becomes more deficit, more deeper than that. Now, for your understanding, let's suppose that the government spending is $50, doesn't matter wherever it's happening, and your tax revenue as follow, which is in case of $20, $30, but the government spending is $50. So the balance when you are your tax revenue is 20, net tax revenue 20, and the $30 that you need to borrow in order to becomes 50, which is this is the amount. And here is where you also, but it's you have $30 as a government and you need to borrow 20. So this is the situation where it's happening, and you can see it here at the real GDP. There is a certain balance where your net tax revenue is 50, which is here at 120 real GDP, and you're not spending, your budget balance is zero. So Keynes theories and model is developed a model in response to the depression. We all know now they developed that because of the depression, and based on that is aggregate expenditure, which as we spoke about it last week, is aggregate expenditure, consumption plus income plus government spending plus export. And we believe that the depression was caused by decreased aggregate expenditures. So the more the decrease happening, the less income is generated and less is getting more reduced. Now, it's argued for the increased government expenditures here, where they say, well, let's spend more. The government can spend more so they can increase the aggregate expenditures, because a positive jump in this will be positive in jump in this, and it will cause the country goes out of the recession or depressions. Now, increases spending financial, so it can be mostly from borrowing, which is will have some side effect on it, which I will, end of this chapter, we'll talk about why sometimes it's not a good that the government should borrow money. But overall, the counter-cyclical fiscal policy, so you have inflationaries and you have recession. And during the recession, the government should do something to counter the to stop this recession. So dealing with a recessionary gap, government will be spending. In other way, also can lower the tax, which because by lowering the tax, people will have more money, so they can spend more. So dealing with a recession gap, raise the government spending or lowering the taxes, total spending, increase the aggregate demand. We know from early chapters that the aggregate demand will be, if there is more income, it will be shifting outside. And if the government spend more, there's more income comes into the hand of the consumers, so that the aggregate demand will be shifting out. And the recession, the recession will be eliminated. Now, the other case, so in summary, when a recessionary gap, government should spend more and tax in a way that increase the aggregate demand. So spend and tax in a way increase the aggregate demand. When there is an inflationary gap, um, the government should spend and tax in a way that reduce the aggregate demand. So the goal is increase and reduce the aggregate demand. How we going to do it when it's a recessionaries? You need to spend and tax in a way that aggregate demand is increases. So how I'm going to increase the aggregate demand is by, if I'm government, I'm spending more, people will have more money and people will be spending more, so aggregate demand will increase. If I'm taxing less, it's the same thing. The government, the people will have more money because less money is taken away from their pocket, and there is more money in their pocket, so there is a shift also in the aggregate demand. And in the inflationary gap, you need to reverse the situation. So let's test our understanding. Let's say in the following case, you need to indicate the direction in which the aggregate demand will shift, right or left. You see, the aggregate demand will shift right this way or left. This is right and this is left. So if we tax more, it means there is a shift to the left because there is less money in the pocket of the people, so the aggregate demand will come less. If the government spending on a good and service decrease, once again, there is less money in the pocket of the people, because if they're not spending, the people are now working and they're not making money, so there is a shift to the left also. The counter cycle of fiscal policy is used to close the recessionary gap. When it's in a recessionary, we showed you that they need to shift the aggregate demand to the right, and if there is a inflationary, it needs to be shifted to the left. Look back 2 slides earlier to understand if you don't understand the CU and D well. Now, the counter-cycle fiscal policy, there is a shortcoming. We said that not always is a perfect policies. Is the timing also is important. Um, the shortcoming, it is subject to a serious time lags. And there is what you call the crowding effect. When the government is borrowing, how the government going to spend more is when they start borrowing money. And if they're borrowing money, we'll talk about in the monetary policy case, when they're borrowing money means that there is less money in the market, so the interest rate will go high. And when the interest rates go high, the business people cannot borrow money to invest in their business. So the interest rate goes high, so the spending will be less. And also it's going to be it's going to be very hard for the private investor to take loan in order to invest in their businesses and hire more people. It also when it has an inflationary bias, because when the government spending, there is more money in the pocket of the people and people will buy more, and there is people are willing to pay more for the same good. And it can cause a serious budget deficit. What is when it's going to be happening is like when you see in the Greece is when the deficit and the payment of the deficit, it's so high that even whenever you generate income, you cannot the government cannot suspend the services that they're providing and paying the deficit in the same time. This is where can have a very serious budget deficit. So What effect will a counter-cycle fiscal policy aim at the closing an inflationary gap have on the level of national income and prices? Aggregate demand decrease, causing the prices and national income fall. So when we said the national income is the real income, which is nominal income divided by the price. So aggregate demand increase, that will increase the prices, and eventually the national income will fall. So the goal of the government is really balance the fiscal policies, but more important, on every cycle they need to, you know, adjust according to their policies. So the recessionary cap, eventually the wages will be forced down, aggregate supplies increases, return economy of the balanced one, and also decrease the price. What does that mean? Here, what's happening. So if you are spending more, there is an increase in the aggregate supplies. And when there is an increase in the aggregate supplies, you will have you know, more products in the market. When the products is more in the market, you will see that the probably the aggregate demand, it goes down. So a shift from here will lower the, first of all, the wages, and also will have a shift in the price level, because the price level will be going down, and then we will have a recessionary, a gap here. So the balance is really to have the potential GDP and aggregate supply and aggregate demand in the same, they hitting each other on the same point. Otherwise, you will have, if it's inside, then you will have kind of a recession, and if it's outside, you will have an inflationary. Now, balanced budget, fiscal policy, the shortcoming in the recession, the government spending is cut back because they have less income, and there is increasing unemployment even more. So you are in a recession, government is not collecting enough taxes, the government needs to cut back on spending or borrowing, so they will cut back on spending, and that eventually will increase the unemployment even more. In a boom side, when the business is booming, when the cycle is booming, government increase spending, so because they're collecting more taxes, more revenue, increasing increasing spending, will people have more money and willing to pay more for the same product, so that will generate an inflation, and your real income, it goes adjusted back. So in this cyclical, the tends to push the economy in the same direction that is leaning in, increasing unemployment and inflationary severity. So overall, the fiscal policy and the balanced budget is tools that is utilized in a short term. You cannot use it for a long term, because that will affect the real, the real income of the people, because of the inflation, because of the increasing interest rate, all these side effect of it. Now, the balanced budget over the length of business cycle, as we said, instead of a 1 year, run a deficit or reduce unemployment during the recessionary gap, run a surplus or reduce the inflation during inflationary gap. So you want to make sure that you fix your balance budget within a year, and you don't need to run too much deficit in order to reduce the unemployment during the recessionary gap, because it might affect you. So you need to balance that one, And once the inflation is happening, you need these to reduce your spending, so the inflation will be lower. So what we have is cyclical versus structural. The structure deficit or a surplus is a deficit or a surplus that exists at full-time, full employment GDPs. So that's the structural one. The cyclical deficit or surplus is a result from a recession, for example, or inflationary boom, because it's cyclical, it goes up and down. Structural is kind of a thing. So a cyclical deficit is result of actual deficit minus structural deficit. Now, in the balanced budget, cyclical balanced budget, the shortcoming, there is no guarantee that the size and the length of the recessionary gap will exactly offset the size and length of inflationary gap. So there is, there is some money when you government spending. We in the early we said some of it go to the saving and some of it will go to spending, and what's spending, some goes to saving and spend. This amount is nothing guarantee that the size of and the length of a recessionary gap will exactly offset the size and length of inflationary gap. So it doesn't mean exactly the wave is up and down, might go up and for a long time and then go down a little bit and goes up again. Um, I think there is one countries who is, uh, uh, they haven't they haven't been in a recession for the last 10 years, so that might be very interesting place. Um, so increasing government spending in bad time is politically easy because government wants to be elected. So in a bad time, they try to spend more, but that eventually, in the long run, will hurt the country. Decreasing government spending in a good time is politically hard. So if you are doing really well as a government and in a good time, and you decide not to spend to save for the future, that will really politically hard for them. So cyclical deficit turn into a structural deficit. Business cycles rarely match the political cycle. So the government blame earlier government for the deficit. You know, always, business cycle comes after the government cycle, and they don't match each other. So always the government says, "Oh, we are running this deficit because the earlier did not spend enough, and the earlier were did." It is a political game that they use it. I suggest that once in a while you keep listening to these news in the in Canadian news, especially in the Parliament. Very important to understand how these things works out. Now, fiscal policy and the national debt. Government, how the government generate their income. We said that they can generate from collecting taxes. The other way they can generate is by borrowing. And how they borrowing? By issuing a government bond. Issuing a bond in a way for raising money. So they collect money by issuing the government bond. This debt is held by individual. So individual comes in and buy government bond, corporation buy the government bond, and a financial institution. Actually, bond, as usual, interest payment redistribute wealth from the taxpayer to the wealthy bonders. So when the government collect taxes, this is take it from everybody. But when they borrow the money and give away bond, well, when they give bond, there is an interest rate they have to pay for it. How this government will pay for this interest rate is getting money from the people and paying it off. And if they're not investing it in the right way, just say they just doing it in a, borrowing money, and eventually they have to pay for that and pay the interest. So they taken from the people and giving it to the wealthy bondholders. Here, you just need to look at the Canada net national debit debt, and it keep increasing. But we said in earlier, it's not always it's a bad thing. Sometimes it's a good thing because you are investing in the futures. So that's an important thing. Now, in the fiscal policy and the national debt, if you notice here, debt as a percentage of GDP above is a better measure of whether the government can afford it. So you need to look at this, start to look and analyze it. If you notice, in 1995, Canada, since 1995, Canada fell into the lowest of the G8 countries as their debts. So they have a very strong situation. But if in 1946, if you notice, there's 113%, which is a very high amount to do it. So we in if you look at the Greece in early years in Mexico, some countries in Caribbean, they had their interest that they were paying is reached to uh, the government income, and that caused a big problem. So the problem with the high deficit or debt is the interest payment that must be paid on the foreigner held debt, how much they have to pay for it. Income redistribution effect of large interest payment. So if let me give it to you, and it's very simple. Let's say I'm making $1,000 and I have to pay an interest of $700. What's remaining is only $300. So the more the interest that I'm paying, the more I'm into, debt. So the government don't want to be borrowing so much and paying interest on it. So the reduced ability of the government to meet the needs, because they know if they have so much debt and they're paying so much interest, so they don't have enough money to meet the government, the people, the citizen need, and possible increased power grabbing and wasteful of government. So here in this chapter, what we learned, that, and things that you need to remember is the federal government budget depends on the rate of taxation, the size of the GDP, and its spending. There is a pros and cons in the fiscal policy or countercycle. There is a pros and cons in balanced budget policies. There's a pros and cons of the psychological balanced budget, and there is also the cause, the size, the problem of national debt. We spoke about it in the last slide. Now, so the situation, I'm gonna attach your assignment, and it's a group assignment. It means you have to do it together, and you divide the work, and then you send me one assignment as a group. You have your, first of all, you need to CC everybody in the email, and also you need to put all the students' number and name in one assignment. So one person will be sending on behalf of the whole team. I wish you good luck. It's due next week, and bye bye.